within the ECB, we conducted our first economy-wide climate stress test to assess to what extent European firms and banks are exposed to climate risk over the next 30 years. And before delving into the results, I would like to give an overview of the framework based on which we conducted our exercise. And so our climate stress test can be characterized by three main elements. The first being three different types of forward-looking climate scenarios in which we vary the magnitude of climate risk and its impact on firms and the economy. The second being a highly granular and rich data set, which we compiled from scratch, where we combined the balance sheet information of individual firms with their climate risk information. And we then subsequently mapped this data to individual loan exposure data of euro area banks. And finally, the third key element is that we developed new risk models in which we account for the transmission of climate risk into the financial risk of firms and then to the credit and market risk of banks. And in terms of the types of climate risk we account for, here we capture on the one hand transition risk, which are the potential increases in carbon costs and energy prices that would lead to a rise in the energy expenditures and operating expenses of firms. We also capture the increase in energy efficiency and technological changes that would lead firms to invest into greener technologies to be less reliant on brown energy sources. And we also capture the demand side effects of transitioning, which would be the decrease in demand for energy-intensive goods, given that the price of these goods would increase due to higher carbon prices. And on the other hand, we also account for physical risks, which would be potential damages to the physical capital of firms stemming from extreme weather events such as wildfires, floods, and sea level rise. And these damages would lead to a disruption in the productive capacity of firms, therefore causing them to lose out on potential revenues. Now, given these transmission channels, we then estimate the evolution of firms' probabilities of default over time and translate the firm-level PDs into bank-level probabilities of default of banks' portfolios. And in addition, we also calculate expected losses that stem from the corporate bond portfolios of banks. Now, moving to the results, first for firms. In these charts, we can see the evolution of firms' probabilities of default over time for three different types of firms. And the way we present the results is as a percentage difference of probabilities of default for two types of adverse scenarios relative to an orderly transition scenario. And for this orderly transition scenario, we assume that transitioning towards carbon neutral economy would happen as of today. Whereas in the two adverse scenarios, we account on the one hand for a disorderly transition scenario, which would be the yellow lines, where we assume that transitioning would happen only in 10 years' time. And on the other hand, we account for a hothouse world scenario, which are the red lines, where we assume that actually no transition would happen at all and temperatures would rise without a limit until 2050. And what we can observe is that in the short term, there are certain costs to transitioning, given that the probabilities of default are higher in an orderly transition. However, these short-term costs are more than outweighed in the long term, given that PDs rise to a larger extent in the disorderly transition and in a hothouse world relative to the baseline. And this holds also true for carbon-intensive firms. And what is even more remarkable is that the increase in PDs in the adverse scenarios relative to the orderly transition scenario increases non-linearly, especially for firms vulnerable to physical risk. So as you can see in the right-hand chart, we can observe that the increase in PDs in a hothouse world relative to the baseline is around 5 times larger for those high physical risk firms relative to the average firm. And when moving to the results for banks, here we observe a very similar picture, where we can see that banks experience short-term costs to transitioning until 2030. However, this effect reverses afterwards, and banks also experience higher probabilities of defaults in their portfolios in the two adverse scenarios relative to the orderly transition scenario. And when looking at the evolution of PDs over time, we actually see that for the average bank, an orderly transition scenario would cause them to decrease their probabilities of default over time and therefore lead to an overall net gain until 2050. However, for the top 10% banks with the highest increase in PDs, this increase relative to 2020 is around 5 times larger than for the average banks. And these 10% banks comprise already 20% of total loan exposures in the euro area. And given this large share of loans in the portfolios of these banks, suggests that there are serious implications from a financial stability perspective when it comes to climate risk, especially in a scenario where no transition happens at all and temperatures would rise without a limit.